Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella, with additional insight from industry veteran Jordan Kimmel. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
And good evening. I'm Michael Hartzman. Today is Tuesday, June 22nd, 2021. And back in his regular seat is Dominick Tavella. Good evening, Dominick.
Good evening, Michael. How are you?
I'm all right. How are you?
Good, good. So the $1 million question, did you miss me at all? Did you miss me?
Of course. Like I said last week, it took both Scott and Jordan to fill your seat. It took two of them.
That's very kind of you to say, but that just qualifies you as a liar. But we'll move forward from here. So
well, they did a good job. So I'm not lying about that, and I appreciate their efforts. So tonight we have an interesting show. We have as our guest the president and founder of American Investment Properties, Ron Koenigsberg, who has owned his own commercial real estate company for 20 years on Long Island. And I'm anxious to get his take on the future of real estate, both Long Island and across the country.
So as they always say, real estate is regional, location. And he's based here on Long Island, but I think he'll give us some pretty good insight into what's going on in this real super transitional period that we're going through, both from an economic perspective, but I think population, employers, employees, working from home. I think we want to get some real hands-on insight into all of that.
I agree. And I think if we would have had him on a year ago, his answer to every question we would have given him would probably been, I don't know. I really don't know. And I think a year later, with the vaccines and the reopening and companies like JP Morgan and Morgan Stanley saying, all right, it's ready to come back to work. Work from home is coming to an end. And then you have the employees pushing back and saying, can we do it hybrid? Can we do it 60% of the time, 50% of the time? So it's really amazing. The world has changed so rapidly in 15 months as it relates to work.
Mike, you hear it as much as I do. CEO after CEO is like, no, this is it now. This is our starting date, and this is when you're coming back to the office. And employees are like, yeah, no. So we are going through a different dynamic at this point, and some of it is due to childcare, and parents really can't. The kids are supposedly still in schools, but getting Zoom lessons, so they can't really leave the household and go back to the office environment. Some is healthcare related. People aren't really 100% comfortable being in a work environment because there's still some fear about COVID. But some of it is lifestyle. They've gotten quite used to and comfortable with this idea that I don't have to spend 2 hours a day commuting in and 2 hours a day commuting out. So we're seeing some pretty significant demographic changes going forward.
We are, and I think we're seeing it, Dominick, on either end of the spectrum, meaning there are the folks in their late 50s, early 60s, late 60s who are thinking, do I really want to get back on the railroad? Do I really want to have to go into the office 5 days a week, even if it's a 45-minute drive? And then there are the millennials. There are the people in their 20s and 30s who claim, and maybe I take it with a grain of salt, that they're willing to earn a little less for a better quality of life. Maybe that's true, maybe it's not, but that's what business owners are having to deal with the changing workforce.
And look, some jobs like ours, we proved that you can be in a different part of the country, a different part of the world, and still do the job. But some jobs, if you think about a waiter or waitress or hotel staff, you got to be there. You can't do it remote. So it's going to have huge impact on the economies and state economies. And we'll be dealing with this one for a really long time. And round circle to our portfolios and how we allocate and where we allocate. These are all big issues.
Right. And even you mentioned the employees, but even the employers, if you own a dry cleaning business or you own a Well, I guess you could set up a hair salon in your house, but if you want a dry cleaning business or a small local hardware store or a bookstore, it's going to be in a storefront. I mean, that's just where it's going to be, or in a fitness center. So there's still many businesses that require Ron's expertise in a commercial real estate environment.
And one of the things we really want to pick his brains about. So, unfortunately, a lot of businesses did go out of business, right? They don't want to come back to those storefronts. They don't want to pay back rent. We hear that as one of the biggest complaints. So they've shut permanently. They've shut down permanently. But there's also another new businesses and a new wave of entrepreneurs, and that's really exciting in terms of the economy, not just short term, but long term. This is where true wealth is created, when small businesses start from nothing and create a substantial amount of value. So again, these are really exciting conversations. I'm looking forward to all of this.
So am I. So on that note, we'll take a quick break and we'll be right back with Ron Koenigsberg from American Investment Properties.
Are you paying federal taxes on your cash? I work hard for my money that I keep in cash. And for the life of me, I can't imagine why anyone would want to pay federal taxes on their cash. That's why I keep my cash in the Lebenthal Ultra Short Tax-Free Income Fund, symbol LETAX, LETAX.
Rates on cash are already so low, why pay federal taxes on the interest your cash earns? Remember, it's not what you earn, it's what you keep. The Lebenthal Ultra Short Tax-Free Income Fund, LETAX, may help you earn more on the cash you've worked hard for and keep more after-tax dollars in your pocket. Find out more about the fund by speaking with a Lebenthal Global Advisors private wealth advisor or its sponsor at dcmadvisors.com.
For your hard-earned cash, why pay the tax when there's the tax?
Lebenthal Ultra Short Tax-Free Income Fund. It's not what you make, it's what you keep. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
All right, I'm Michael Hartzman, back with Dominick Tavella and our guest this evening, Ron Koenigsberg. How are you, Ron?
I'm well, Michael. Thanks for having me tonight. I appreciate being on with you guys.
Welcome
Thank
on
you.
board, Ron. Nice to have you here and looking forward to this conversation.
Thanks, Dominic.
So, Ron, let me just ask you the first question, which I've been thinking about all week since we decided to have you on the show. Just take me back to last March when storefronts were shutting down that were non-essential. Office buildings were empty, right? No one was going into the office. What were you thinking as someone who's basically spent most of their life working in this space, working with office building owners and strip mall owners and just take me back to what your thoughts were in terms of how you felt the next couple of months would have unfolded, and did they unfold in a way you thought they would?
All right. I made a decision personally, Michael, at that point that I needed to put blinders on. I needed to be a commercial real estate broker and stay on the phone. I felt that most commercial brokers and most professionals, because of the uncertainty, they didn't feel like they could advise people properly, and they may have shied away from being in a position where they were on the phone. So I was back on the phone immediately. I never got off, whether it be home or here at, working remotely. And, it was scary. It was scary. It was very scary, particularly because my expertise, listen, there are four sectors of commercial real estate, and we could talk about all four. multifamily, industrial, retail, and office, but I specialize in retail primarily and office. Two areas of the marketplace where change is really, particularly in March. I spoke to the largest owner of commercial real estate on Long Island. And at the time I said, what are you doing? And he said to me, I'm protecting, the whole franchise. It was scary, no question. Very unpredictable, very unpredictable. And for retail, I saw a lot of people going in a lot of different ways. Meaning tenants were communicating with their landlords, and some landlords weren't communicating back, and they went out of business. And that's what Dominick said. It was a time to be nimble, and most of those COVID-19 concessions, particularly for the retailers, have burnt out now that we're in June of 2021. But I knew a lot of real estate people were, rewriting leases or amendments to their leases, and they were allowing concessions not to lose tenants. So it was frightening, particularly in retail. Yeah, particularly in the retail sector.
Ron, I have a slew of questions, but the first comment I want to make is your response to the crisis. And it really kind of goes back to our experience in 2008, right, Mike, when the market went through that dreadful financial crisis and correction. And there were advisors, brokers that literally were not returning phone calls and hiding under the desk. And that's the worst thing to do.
Yeah, it is the worst, but it's understandable. The understandable thing is when you don't know what to do, a lot of people don't do anything. And I get that. And for a minute, I got shook and I said, what do I do? And I know what I do. I'm on the phone. I'm on the phone 10 hours a day. I wear out these headsets. I go through them. And I was on the phone, and basically I wasn't creating any new thoughts. I was taking information from one owner and sharing it with the next, to the banks, to the tenants, and sharing information. And I stayed in the loop that way. Listen, the bottom line about COVID, if there's one major takeaway, guys, for commercial real estate, I don't believe that COVID changed commercial real estate. I believe it exposed commercial real estate and pushed commercial real estate very far along to where it was going anyway. Here on Long Island, we've been seeing office vacancies, increasing since 2014. Work from home isn't new. Work from home just got revealed during the pandemic. Technology is the only game changer that matters. So with the ability to work from home, it just revealed it. The ability to shop from home on the internet for everything, including groceries, just got revealed. Okay. Now, industrial sector, listen, that went crazy. There's this concept of the last mile of retail. Instead of you going to Dick's Sporting Goods to get your baseball bat for your son, or for my son, or for anybody else out there getting a baseball mitt, or it could be delivered to an Amazon warehouse fulfillment center and delivered to your front door. So industrial and multi on Long Island, apartments, there isn't enough of it. And throughout the country, what we're seeing is cap rates or investments into those areas be suppressed. The return isn't as great in multifamily because people, as we've seen the residential markets, particularly multi on Long Island, there's a tremendous demand for it. Not only your home, it's your office now too. So people are spending, more time. Office, office, we're going to see what the future brings as leases expire.
Ron, I know right outside that window, you're about 100 yards away from the fourth largest mall, I think, in America, the Roosevelt Field Mall. So forget your own experience. Just looking out the window, looking at the parking lot on a daily basis, is retail coming back? Are the shoppers returning? Is the parking lot crowded?
Yeah, very much so. Yeah, very much so. I remember going in there and seeing that 40 stores last March out of the 400 were 10% were going out of business. You know, it is a dynamic mall, and I don't believe that this mall is a good representation of all the malls out there. Roosevelt Field is a tremendous mall, but in general terms, to answer your question specifically, yes, people are back shopping. Foot traffic is increasing where it was dead.
And Ron, we always talk about real estate as being very regional. I think what's going on here on Long Island or maybe Florida is quite different than what's going on in Manhattan. Can you talk a little bit about, the office environment in Manhattan or large cities in general versus the suburbs and maybe some of the states that are a little bit more attractive?
Right. That's easiest for me because, as a specialist or professional commercial real estate professional in Nassau and Suffolk counties, which interestingly enough, Nassau and Suffolk is actually the 14th largest economy in America. So, there's 1 million people here in Nassau and 1 million people in Suffolk. But yeah, no, it's vastly different in the 5 boroughs, in particular in Manhattan. At one point, I do recall very recently, where 11% of employees were at their desks. Now it's anticipated that the end of this summer into the fall, it's anticipated that 62% of employees will be back at their desks, which is unimaginable. I mean, that's 38%, Michael, of people that won't be back at their desk. That's 38% of the decision makers that are probably not going to be renewing that lease. They're either going to renew that lease for smaller space or not at all as technology increases. And Dominick, furthermore, that they expect, or it's anticipated that out of those 62% of employees back at their desk, they're only going to be there 3 days a week.
So what does that do to the local coffee shop, diner, restaurant, boutique within walking distance, right? Those little small business owners that really depend on that foot traffic.
I agree with you. I mean, I think the only, consistent answer to that is more the same, meaning they suffered through the pandemic, but now, yeah, in general terms, for the foreseeable future or temporarily, I'm worried more so about Manhattan and the 5 boroughs than I am about the retailers on Long Island. And that's because, just this one particular market, the bottom line is those rents are very high and they're not sustainable. And it's hard to do business in this environment. And yeah, I mean, I don't want to dig this deep, but I think about it a lot. The telephone, the light bulb, the television, the personal computer, GPS, cell phones, technology, air conditioning changes the game. Work from home is an alternative that it's here. And maybe we're taking a look at the year 2030, 9 years or 7 years or 6 years or 10 years before we got there, because the pandemic taught us to rely on the internet more. We're on a Zoom call. Now, it's unimaginable 2 years ago. You know what I mean?
Yeah.
So, it's evidence. And Micah, it looks like you're working from your professional office at home.
I am.
So, yeah, I think that this is very illuminating of where we're at. You don't have to go too far. You're at your professional office at home. Yeah, I'm sitting in my office, but I could have done this at home. And, Dominick, it looks like you're in your office.
But Ron, you may know, I did one of these from Italy. I have a house there, and we
Well, there you go.
from there.
There you go. You think 24 months ago we knew what Zoom was?
Correct. Can
So-
function from anywhere now.
Right. Right. Technology is a game changer. I think we're going to continue to see inroads into work from home. What does that do? Well, this is going to really create game-changing, things for the retailers, for the office market, for industrial, and for multifamily.
So Ron, let me ask you this. I remember you and I had lunch, God, it had to be 5 or 6 years ago. It could have been more. And you were telling me then how the face of commercial real estate was changing dramatically. And you said to me, the anchor now is not a large retail store. The anchor now is either a gym, a fitness center, or a medical center where the local hospital is building out medi centers. And these were the new anchors, right? The new key tenant that you had to look for. So here we are down the road 5 or 6 years later, neither one of us or three of us thought we lived through a pandemic. What do you see in the future now for commercial real estate in terms of those trends? Because you were spot on then. And what do you see, as you said, 5, 6 years from now on the retail space?
Retail is the most challenging. When we think about Amazon, when we think about online retail, when we think about the growth, the percentage growth rates, the double-digit percentage growth rates of money that's traveling, online, the cat is out of the bag. This is not a surprise to anybody. And what I think specifically what I spoke about maybe 5 years ago when we had lunch was we were losing our selection of new tenants. And what we're seeing as, an ancillary tenant, like a doc, an emergency doctor room, or a gym tenant, or a gym use, was, more dominant. We're consistently seeing a shift. Listen, there are many people are still shopping at the supermarket, but Whole Foods delivery, Fresh Direct are making inroads into all of these staple items. We're going to continue to see a disruption in retail. But on the other hand, Dominic, 2020 saw the greatest amount of new businesses, in the history of the planet, history of America. So retailers are coming back in and saying, hey, don't count me out. I think a lot of those vacancies out of the 40 out of the 400 at Roosevelt Field are now occupied. They're not traditional tenants. There's a teeth whitening guy in there. He's doing a great business. Is that the future of retail? There's a guy in there who makes custom donuts. You want yours with cinnamon on it or something like that? You want yours this way or that way? Don't give up on the American engine. They're out there making donuts so we can go get teeth whitened.
Are they partners?
No, the point is, the point is the ingenuity is out there, and the retailers are going to survive.
So, Ron, I'm so happy you brought that up. I mean, we don't spend enough time talking about that, but there was literally the largest creation of new businesses in the history of this country. Not all of them will be successful. Not all of them will be around 5 years from now. But the entrepreneurs that go through this survive. That's where generational wealth is created. The small business owner, most of the hiring in this country comes from small business owners. So this really means it's the real estate market and the office environment, the strip malls. This is an evolution to the next stage, right?
Absolutely. Absolutely. Bottom line is the economy is strong. As far as commercial real estate is concerned, cap rates and risk rates is how we're rewarded. Multi-family on Long Island, you can't touch it, and the cap rates are so low, there's no return in it. And the same is true of industrial. But the reason why the markets, in my opinion, didn't collapse has a lot more to do with your area of the marketplace, and that's the Federal Reserve and how they lowered interest rates and how they monitored, they lent, we're doing deals now, and there's a lot being done. There's more risk in retail, and that's factored in. And there's more risk in office, and that's factored in. But with low interest rates, the return is there, and people are actively investing in commercial real estate. And what I think the future holds is a lot of the repurposing of these, retail properties. Change is difficult, change is slow, but I do believe that we're going to see building departments and environments where there's going to be a lot more open-mindedness, for a tax base and also for a use base. We don't want to see vacancies, particularly in retail. It's so visible.
And you mentioned Amazon, and that is one other way Amazon has changed the economy. They are building these last mile huge centers all over the country. And people usually look at these industrial complex as like the blot of a neighborhood, but these industrial centers are becoming more important. To your point, I think Amazon is leading the way when it comes to that.
Listen, I don't know how much time we have.
2 minutes.
2 minutes.
Maybe less.
Maybe less. Commercial real estate is very resilient, and there's going to be a lot of change in it. What's on your mind, Dominic?
But yeah, I want to jump in because I think I literally want to serve it to you on a silver platter. The way you combat an Amazon is exactly the donut guy who's making custom donuts, right? It's the boutique, it's the specialty. They can charge a premium. And that really, I think, is very positive for the storefront and the retail space, because you can't compete against Amazon one-on-one, right? But if you're making a custom donut, or you're a boutique shop, or you're a boutique restaurant, you're going to beat Amazon all day long.
Experiences. And that's where, listen, prior to the pandemic, we were going to experiential retail anyway. Meaning there was a reason to get up and go to the mall, or a reason to get up and go to a store. They could literally, with a picture or something, put the furniture in your room. They're giving you an experience. You go for the restaurant experience. You go for that donut experience, the teeth whitening experience, or the experience that's unbelievable for getting up and going to the store. So they are very resilient. And they're coming up with a human experience. Retail has got challenges, but I expect big things. I expect them to fight right back.
Ron, it's great to know that the entrepreneur is alive and well. And this was enlightening. Thank you very much. We owe you a dozen donuts.
At least. And again, I'm so happy to hear that, it can be doom and gloom sometimes. It looks that way, but the future's bright. The future for this country is very bright.
Very resilient. And I think that and I'll leave you with this, just as we came out of the pandemic of 1918, we went into the roaring 20s and a financial boom of a decade. I see that right now. And I'm really putting my money where my mouth is, meaning I just expanded my firm because I believe the future is very bright.
Well,
and I believe in the American
economy. Best wishes.
Thank you.
Good luck.
Thanks.
Thanks, Ron. We appreciate your time this evening.
Thank you, Ron.
Have a great night. We'll be right back, everybody. When you're thinking about where to park your cash, for over 30 years in the business, I've been a fan of funds like the Lebenthal Ultra Short Tax-Free Income Fund. It's managed for cash and designed so the interest income you receive is free from federal taxes. And who doesn't love paying less taxes?
Mike, generating interest that's free from federal taxes is appealing, but I've been in this business for a long time, and people love the potential for more income on their hard-earned cash.
Sorry, Dom. But the beauty of the fund is paying less taxes on cash.
No, my friend, it's the potential for more income.
Less taxes.
More income.
Less taxes.
More income.
Less
for
taxes.
your cash.
More income.
Ask your advisor about the Lebenthal Ultra Short Tax-Free Income Fund.
Less taxes.
Or find out more at dcmadvisors.com.
tax.
Well, Dom, one thing I know we agree on, it's not what you earn.
It's what you keep.
Lebenthal Ultra Short Tax-Free Income Fund. Symbol LETAX. LETAX. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
And welcome back to the Lebenthal Report. I'm Jordan Kimmel, Chief Equity Strategist and Portfolio Manager. And it's a pleasure to have on once again my colleague, my friend for a long time, our Chief Risk Officer, Ed Matluck, founder and president of Hedgemetrics. Ed, thanks so much for joining us.
Great to be here.
So Ed, listen, I want to dig in for a while because we were thinking about who to have on today. And I said, let's get into the practitioner side. This is really what we do. And the market has been so interesting in the last couple of weeks and the rotation. So before we jump into, I think, what is exactly going on and what we anticipate, I want to just share that Ed, as a risk manager for many portfolios and evaluating several, you have a real flavor and a finger for what's going on in the market at any one time. And there's been dramatic rotation. So maybe I'll let you just start with what you think is the most important things you've observed by the market's reaction over the last couple of weeks of the Fed, the announcements, and the rotation itself.
Well, okay, the rotation has been very interesting because for a couple of weeks, the market was sort of flat every day. It would be up in the morning and then it would go down in the afternoon. And it looked like nothing was happening at all. But underneath, there was big difference in which stocks were up and which stocks were down. And essentially, you were rotating in the last 2 weeks away from tech and growth and towards value and quality. And that's sort of a standard rotation when the economy slows down. And while the economy wasn't slowing down, there was an expectation that the Fed was going to slow it down. And that's really what was behind the movement. And when the Fed actually spoke, or Powell spoke after the close of the Fed meeting, it sounded like that's exactly what he was going to do. I don't think he meant to say that. He was trying to say that someday interest rates are going to go back up. But the way he said it, it sounded like it was pretty soon. Right. And because there had been some recent consumer inflation due to shortages and what have you from the pandemic, the CPI had been higher than expected, and the WPI had been a little higher than expected. So a feeling started to go through the bond market that interest rate increases might become sooner rather than later, or sooner than had been expected. But that wasn't true because unemployment is still close to 6%. And the current administration isn't going to allow that. And the Fed is one of its two directives is to manage employment as well as inflation. So there was no way that the Fed was going to raise interest rates. And finally, yesterday and today, the Fed speakers sort of made that obvious to the market. And so the market really turned around and you saw a move back towards large cap growth. And what happened is over the last couple of weeks, when large cap growth was not moving, but their earnings were good. So what happened is your price to earnings ratios and your price to sales ratios started to come down into more reasonable levels than they had been at. And now you can buy technology without being, petrified that you're in skyrocketing valuation.
So let me just touch on that for a moment, because it's so important. And again, you want to try to let the market just be, and you want to just react if you can. But several months ago, you came to me as the risk manager. You said, listen, tech is dramatically 3-4 standard deviations to the right here. You got to kind of pare it back. There's a rotation coming, and it's exactly what happened. But now suddenly there's a rotation again. What's happening? And again, what I think is really important, Ed, is you're an economist by training, but you're a portfolio manager and a risk manager by profession. And what I'm saying here is we're seeing numbers like GDP, 10%. I mean, on the most mature, largest economy in the world, these numbers are baffling. So they're confusing people. But I think what you've been suggesting right now is that the discount to value and the discount to quality to the overall market is one of the best we've seen. And so I'm actually, as you are, pretty bullish on the market and our portfolios themselves.
Right, correct. Right now, anyway, what we had was 3 weeks ago or 4 weeks ago, technology was almost 4 standard deviations. The return to technology was 4 standard deviations above the average. And so you expect that that's going to mean revert. And it did. And now it's about a half standard deviation below the average, and which means you can buy it. It's sort of at its normal level of risk. There's never no risk, but the risk is more reasonable. And same thing with quality. Quality was also, actually quality was below its average because people have been buying high growth risky stocks. And now they started buying higher quality, less volatile stocks, and those have risen to the point where they're sort of fair value. So right. You can still buy those as well. So you can buy things for the long term.
So what I've shared internally is that I kind of wish I was back in the days of the 50s when things moved 1/8 of a point a day. And at the end of a month, it was 1 percentage point. But what Ron just talked about in the previous segment, I love that segment. And by the way, it really made me want to have a donut right now.
Right.
He's selling donuts. But the point is that you can't just kind of sit there and these corrections that come aren't 1/8% anymore. So when you see these standard deviations, the point is, having an active portfolio and being able to really react to these dramatic overbought and oversold levels, I think we might agree that might have better performance in the indexes itself by just sitting there and let the indexes come up and down.
Right. Well, let me just say Krispy Kreme went public last week. But anyway, what happens now, because information is so available to everybody so quickly, that these corrections and movements of sectors happen overnight. And you can get like a 2 standard deviation move in an industry in a week. And you never used to see that before. But now you have to keep up on where industries are and where the sectors are, and very, very all the time, because you can be out of touch in 3 or 4 days.
Right. And so we haven't seen the market, I don't think, trade with this much energy. And to your point, the S&P looks flat to everybody else. I think the average stock was down over 10% going into today. It's been a rotating bull market, which very few new lows, Ed. But I think that the thing that I want to bring Mike and Dom on right now is that there's an issue that how much risk is still out there. I believe that most investors right now think that everything hits a higher bottom and a higher top, and I just think underestimates the risk. So for someone who's been doing risk management for 30 years on Wall Street, let Dom and Mike come in and ask some questions on what you're seeing and what they're.
Yeah, let me just give you one statistic.
Okay, sure.
3 weeks ago, 90% of the large cap growth stocks were above their 50-day moving average. And last Friday, it was down to 40%.
Wow. Yeah, it was stealthy, but it was severe. Very
Right.
interesting point. Thank you.
So Ed, I know Jordan touched on it. We spoke about it with our advisor call this morning. If you look at the S&P 500, it's virtually, I know we've had a few ups and downs, but it's virtually unchanged over the last 3 months. But the internals have been really, really volatile, this rotation that you're talking about. So what does the picture look like going forward?
Well, hopefully it will be a little more reasonable, but you will certainly have rotation. I mean, one of the things that sort of made the rotations more volatile than normal was this work at home thing. And as you had more and more people working at home, there were more and more companies or stocks that benefited from that, and some that were hurt by it. And so that switch, some of that switch can be identified by sectors and industries, but some of it crosses the sectors and industries. Like in Amazon, some people call it a consumer cyclical now because, so they own Whole Foods. And at the same time, they're, very related to the web with AWS and what have you. So you're getting these rotations, not only in and out of sectors, but in and out of different levels of valuations, much more rapidly than you had them before.
Ed, this is Michael. Thanks for coming on tonight.
Sure, great to be here.
Thank you. You made a comment about how quickly the standard deviations change and how these sell-offs seem to self-correct pretty rapidly. And I've been saying that for a while, that for the last 5 or 6 or 7 years, these sell-offs just seem to be different. And Mark Zandi over the weekend made a comment that he feels the market's going to go down 20% and stay down, which is really counterintuitive to what we've been hearing and experiencing the last 4 or 5 years. Do you have an opinion on that? Could you speak to that?
Well, I can speak to it. There's 2 ways to look at the market. One is the short term, where you have your technicals and short-term rotations that we're talking about. And then there's looking at it the long term, where you look at corporate debt ratios and government debt ratios. Mm-hmm. And many, many economists who've studied these things over the long term have found a big negative relationship between debt and outstanding debt and just the valuation of the market. And so our outstanding debt is in the multiple trillions and is growing, and it's going to grow much more from the current stimulus that's getting possibly going through in the next year or two. And over time, if you look out 5 years, that debt has to get paid down, and if it's not, statistically, statistics say that the market will go down, and that or at least valuations will go down by almost half. And so it's something that is out there, but you can't see it yet. And there'll be, economists saying that we have to deal with this, and there'll be politicians resisting it. And, no one knows what the result will be.
Hey,
but
Ed,
it is
we're hearing a lot of talk about inflation and cost of goods and materials. Any opinions on the material sector and energy specifically?
Well, I think that energy will do all right. I think that, the U.S., there's a debate of how much excess capacity OPEC has and whether or not they're going to use it if prices get closer to $100 a barrel. But with the economies of the world returning to growth, I think that we can certainly see, $80 oil with no problem at all. Technically, there'll probably be a retracement first. But, if you look at 12 to 18 months, I think you can see, oil moving closer to 100. And that should help the energy sector. The U.S. energy sector has underinvested over the past couple of years. So I don't think production here will grow as fast as it did in the 2011 to 2014 period. But it will be certainly, the stocks have plenty of room to move.
Right. Hey, Don, let me jump in to wrap us up here, Ed. And the thing is, you did mention something that I just have to highlight before we jump off, is that people will say in retrospect, we saw this coming. In retrospect, we saw an overvalued market. What we're doing here, Ed, as you know, at Lebenthal, is running very risk-controlled portfolios and making sure that we and our clients aren't saying, why didn't we see this? So I love your risk control. I love the risk management. And please stay on top of me to continue to reduce the risk in the portfolios. And we know in the long run, everything will work out. So let me kind of say, we'll be right back with more Lebenthal Report. And Ed, thanks so much for joining us.
Thank you.
We'll be right back after this quick break.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominick Tavella. And Dom, as we were on our little break listening to Jordan interview Ed, I was thinking about the conversation we had with Ron, and it dawned upon me when he was talking about the entrepreneurs in this country and the engine of this country and the donut shops replacing small retailers. Dominick, where'd all the video stores go? I mean, remember, 30 years ago, there was literally a video store every half a mile.
And privately owned, right? And the big corporations moved in, and streaming moved in and took over for them. And the world changed, the world evolved, right? So in some aspects, it's a death of an industry, right? But then it's the rebirth of something new and hopefully better. And, we're often discussing what's going on in this country, demographics and the cities and office space and retail. There is a light. There's a light out there that says it'll be different, and we don't know quite what it's going to look like, but it will get better. And I think that speaks very highly of the entrepreneurship spirit in this country and the health of the economy.
Yeah. And even Dominick, even 10 or 15 years ago, remember all the local independent phone stores? If you think about it, they're all gone too, right? There were no more independent phone stores where you could pick your network and buy different electronics in addition to the phone. They just vanished, and something steps in to replace them, some new innovation, some new technology, some new trend.
Yeah, look, in our world, we call them the winners and the losers, right? Because when one, whether it's a boutique or a shop or an industry goes out, something comes in to replace it. That's why, the economy continues to grow and wealth is created. So there's some sadness to see some of these businesses go out. But the idea that we've had the largest single number of new businesses started in the last 12 months that we've ever had in the history of this country, my God, the prospects are positive, right?
They are very positive. And we've heard Ron say it. We've heard other economists saying it. The commercial real estate world was changing before the pandemic. Technology was changing before the pandemic. And what the pandemic has done is accelerated these changes by 5 to 10 years.
Yeah, and the sad part is that because of the pandemic, we became more accepting of these changes, right? Quicker. The idea of your groceries being delivered to your front door. Who would ever do that, right? You go, you pick out whatever you want. Now you don't need to do that. So it's different. It's eating. I always joked about it, eating with your left hand instead of your right. So you get used to it. It becomes comfortable, and now it's the norm, right? But going forward, we'll figure out what the norm means, and looking forward to a brighter future.
Yes, we're always looking forward to a brighter future, but that also always includes new technology and new services. Whether it's Uber or whether it's on-demand liquor being delivered to your door, or meals completely prepared delivered to your door. But we still got to go out every now and again, right? We still have to go get a haircut, and we still have to go pick up the dry cleaning. So the retail space, Dominic, is not completely dead.
No, I think, like I mentioned to Ron, I think it becomes more customizable, more boutique-ish. But from our side, this is not just conversation. We want to look at the sectors and the fields and the businesses that will thrive in this environment, and also accept that some businesses won't, or they have to adapt and change. And that really dictates where we drive our investment dollars and how we allocate them.
I agree. And on that note, Dominic, the most important question is, do you want a chocolate frosted or one stuffed with apple?
Whatever my grandchildren decide.
On that note, have a great night, everyone. We will be back here next week.
Thank you, Michael.
Thanks for tuning in to the Lebenthal Report. Dominick, Michael, and Jordan will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week.